If you've ever talked to an institutional private lender and felt like they were speaking a completely different language, you're not alone. Terms like BPL, RTL, capital markets, balance sheet, it really can feel like Wall Street jargon is getting thrown at real estate investors. I've funded millions and millions of dollars in hard money loans for hundreds of investors, and I work directly inside this institutional lending world. So today I'm going to break down 16 common terms you'll hear from institutional private lenders, also known as hard money lenders or bridge lenders, and explain what they actually mean. So let's get into it. The first is BPL. BPL stands for Business Purpose Lending or Business Purpose Loans. This refers to any loan secured by real estate that is not owner occupied. If the property is an investment property, rental, flip, or development, that's considered a business purpose. Institutional capital separates consumer loans or those owner occupied loans from business purpose loans. Most institutions that buy consumer mortgages do not buy business purpose loans. So if your property is for an investment, it falls under that BPL category. The next term is residential, which in institutional lending, this just refers to properties within 1 to 4 units, single family homes, duplexes, triplexes, and fourplexes. This applies whether it's owner occupied or an investment. The unit count is what defines it as residential. So your rental duplex and your primary home are both classified as residential, but they fall under different loan categories based on purpose. So the third one is going to be commercial, and this one confuses people. Commercial in this context means one of two things. First, it refers to properties with 5 or more units, apartment buildings, or multifamily complexes. Second, it covers traditional commercial asset classes. When you think of commercial, such as retail, office, industrial, mixed use, self-storage, and so on. So if someone says commercial loan, they could mean a 20-unit apartment deal or a strip mall. The key distinction from residential is either the unit count or the property type itself. The next term we're going to go over is DSCR, Debt Service Coverage Ratio. The DSCR is both a ratio and a loan type. In today's lending world, when someone says DSCR loan, they're usually referring to a long-term rental loan where the qualification is based on rental income, not your personal income. These are typically 30-year terms, fixed rates, or sometimes adjustable, and the one qualifier is they come with a prepayment penalty, typically around 3 years. And we'll get into exactly what that means a little bit later on. The key qualifier is whether the property's rent covers the debt payments. So speaking of rentals and DSCRs, let's talk about the next term, which is LTR, long-term rental. LTR is just another term used for DSCR loans secured by long-term leased properties. Originally, lenders used LTR before DSCR became a more popular term. In practice, LTR and DSCR are often interchangeable, with the one caveat of STR, which stands for short-term rental. So these STR loans are a type of DSCR loan, but they're secured by short-term rentals like Airbnb or VRBO properties. These are still based on projected annual income, even though the monthly income fluctuates. Lenders use market data, rental projections, or past rental performance to underwrite these deals. So moving on, the next term we're going to discuss is bridge loan. A bridge loan is any short-term loan, typically under 2 years, that includes fix and flips, rehab projects, ground-up construction, value-add rentals, or equity cash-out deals. If it matures in under 2 years, it's usually considered a bridge loan. Anything longer is generally structured as a DSCR. So with that, we'll talk about the next term, RTL, Residential Transition Loan. This is another term for a short-term loan specifically tied to a renovation or construction project. It refers to transitioning a property. So this can apply from a distressed to renovated property or from land to new construction. Most of what I fund on the short-term side would be qualified as RTL. Those are a lot of those standard fix and flips. And so with fix and flips or new construction, 3 terms that you really need to know, and we're going to talk about all of this section, is the LTV, LTC, and LTARV. These 3 ratios come up on every single deal, and investors mix them up all the time. So first off, LTV, loan to value. This is your loan amount for the purchase divided by the current value of the property. If a property is worth $500,000 and you're borrowing $350,000 for the purchase, that's 70% LTV. This is the most common ratio you'll see on stabilized rentals or DSCR deals. So next is LTC, loan to cost. This is your loan amount divided by your total cost basis, purchase price plus rehab budget. This is the ratio that matters the most on bridge loans and fix and flip deals. A lender might say that they'll go up to 90% loan to cost. This means that they'll lend up to 90% of your total project cost. Lastly is LTARV, which stands for loan to after repair value. This is your total loan divided by what the property will be worth after renovations are complete. So if a property appraises for $400,000 once the work is done and your loan is $300,000, that's 75% of ARV. Here's why this matters. On a bridge deal, a lender might quote you 90% loan to cost and 75% LTARV. Both limits apply. You get the lesser of the two. So you need to understand how each ratio works because they work together to determine your actual loan amount. Next is draw schedule. When you get a bridge loan or construction loan, you typically don't receive all your rehab funds up front. Instead, the lender holds the rehab portion in a reserve and releases it in draws as the work gets completed. Here's how it usually works. You complete a phase of the renovation, you request a draw, the lender sends out an inspector to verify the work is done, and then they release the portion of the funds, usually within a few business days. Some lenders do draws in 2 or 3 phases, some break it down way more granularly. It depends on the lender and the size of the project. The key thing to understand is that rehab money is released in arrears, meaning after the work is done, not before. So you need to have cash or a credit line to front the renovation costs between draws. This catches a lot of newer investors off guard, so make sure you plan for it. Track record requirements. This is one of the biggest factors that affects your pricing and leverage on a deal. Institutional lenders tier their borrowers by experience, and experience is measured by your track record. Typically, that means completed flips or builds that you've exited within the last 36 months and rentals that you have been on title for at least 12 months. The key word is on title. If you were a partner on a deal but you weren't on title, most institutional lenders won't count it. They want to see your name on the deed or the entity's name in which you were a principal of. A first-time investor might get 80% loan to cost, while an investor with 10 plus exits might get 95 loan to cost and better rate pricing. Same property, same deal, but your track record changes your terms significantly. So if you're early on your career, understand that building a verifiable track record is one of the most valuable things that you could do for your financing. Next is seasoning period. Seasoning refers to how long you've owned a property, and it directly affects how the lender determines value. Here's the standard rule. If you've owned a property for less than 12 months, most institutional lenders will use your original purchase price as the value, not a new appraisal. Why this is? It's because if you bought a property 6 months ago for $300,000 and now you're saying it's worth $450,000, the lender wants to know what actually changed. If the market just moved, that's just a risk they don't want to take. That's considered rapid market appreciation. There is an exception though, and that's if you have documented value add, meaning you completed a renovation. If you bought a property for $300,000, put $80,000 into a full rehab, and now it appraises at $450,000, most lenders will now go off the higher value with as little as 90 days of seasoning, sometimes sooner, because the value increase is justified by the work that was done. But if there was no rehab done and you have not been on the title of the property for more than a year, expect the lender to cap your value at what you paid for it. This comes up a lot on cash out refinances, and understanding seasoning will save you from a surprise mid-deal. So prepayment penalty, I know I teased this a little bit earlier. The prepayment penalty is a fee that you pay if you pay off your loan early. This is most common on DSCR and long-term rental loans, not so much on bridge lenders unless you're using a very traditional old school hard money guy. You'll usually see a structure like a 5-4-3-2-1 prepayment penalty on a DSCR, meaning if you pay off in year 1, it's 5% of the loan balance, year 2 is 4%, and so on and so forth. So why do lenders do this? It's because they're selling these loans to investors who expect a certain return over time. If you pay it off in 6 months, the investor loses yield, and the lender needs to account for that. So the takeaway here is always ask about the prepayment penalty before you close, especially on DSCR loans. If you think that there's any chance you'll sell or refinance within the first couple of years, the prepayment penalty can significantly eat into your profit. And this is negotiable, so you can ask for lower prepayment penalties, but understand that may affect your interest rate. So number 14 is non-recourse and full recourse guarantees. This is about what happens if things go wrong. A full recourse loan means the lender can come after you personally, your assets, your bank account, everything, if the property doesn't cover the debt in the case of a foreclosure. On residential investment loans, Full recourse is the norm. That's the standard across most institutional bridge and DSCR lenders in the 1 to 4 unit space. On the other hand, a non-recourse loan means the lender's recovery is limited to the property itself. If the deal goes sideways, they take the property, but they can't pursue your personal assets. Now, non-recourse doesn't mean zero liability. There's almost always a personal guarantee with what's called bad boy carve-outs. This means that the loan is non-recourse unless you do something like committing fraud, misrepresenting your financials or the property's financials, or letting the property fall into disrepair intentionally. If you trigger one of these carve-outs, it becomes full recourse. Where you'll see non-recourse more often is on the commercial side, larger apartment deals, 5+ units, bigger loan amounts. At that level, non-recourse structures are more common. On the residential side, if someone is offering you non-recourse, make sure you read the fine print, understand the carve-outs, because the guarantee still likely has teeth. So number 15 is balance sheet lender. When a lender says that they fund off their balance sheet, this just means that they use their capital that they directly control to fund loans. However, in institutional lendings, most loans are sold after closing to recycle capital. If a lender truly keeps loans long-term, they are more of a traditional balance sheet lender. Number 16 is capital markets. And capital markets refers to the process of selling these loans to institutional buyers. Institutional lenders underwrite loans to specific guidelines so these loans can be sold after funding. That's just how large-scale private lending operates. Capital gets recycled quickly to allow them to fund more deals. Why does this matter to you? That's because institutional capital has brought massive amounts of money into private lending. That's helped investors access capital faster and often at better pricing than traditional private lending used to offer. Even when rates increased, institutional lenders continued funding deals at scale. And understanding these terms can help you evaluate who you're working with and how their capital is structured. If you're currently evaluating a deal and want to understand how I would structure it, whether it's a bridge, DSCR, RTL, or something even more complex, click the first link in the description and reach out to us directly. I've structured millions in hard money loans across multiple markets, and I'll walk you through exactly what makes sense for your situation. Institutional lending, it doesn't have to feel complicated, but you do need to understand the language. If this was helpful, make sure you're subscribed, and I'll see you in the next video. And if you're ready to fund your deal, click the first link in the description and let's talk.